And today is February 20th, 2015, and we're in a green market. And I want to show you a stock that we're looking at that is hitting all-time highs, and it is breaking above its breakout point. So let's take a look at it. It's Ulta Salon. We've already screened it for fundamentals. This thing's got dynamite return on equity of 23%. It's growing at a 44% annual growth rate. And it's doing all the right things. And when you're in retail, you want to keep opening stores. And they have 675 beauty stores in 46 states. They sell hair care products, cosmetics, other things like that. And they're raising their revenues. They're doing all the right things. Earnings per share is increasing. And you know, this thing could be considered what we call a chugger. Basically just chugs along above its 50-day moving average. And so let's take a look at what we've got going on. Here's a cup and handle, a big long cup and handle that happened over many weeks. And the handle let the sellers get out. So there was a lot of selling pressure there. That's all out of the way now. That's the overhead resistance that was there in Ulta Salons. So that was the first base, and then you saw it hit that buy point here. It broke out on good volume, and then you saw it come up here and consolidate for 6 or 7 weeks. And now it broke above its high. That's what this purple line is, this long purple line. That's that's its previous high from back in 2014. And now the stock has, that's actually 2013. Now the stock is actually hitting highs. It's broken above this level here, which is the breakout point. It's about 2% above the breakout point, right about 137.50. So we don't want to chase it, but right now it's in that zone. See, we have this little buy zone, this envelope here. That's where you can buy the stock. After that, you're kind of chasing it, and you're better off letting it retrace. You could violate the rule every once in a while, and you're not too penalized. But we just like to buy it right in here in this sweet spot between the 50-day moving average or the 10-week on this chart, and this envelope level that we've set up just above that, and that gives us that margin of safety that we like. So let's look at it. We're looking at the buy range to be about 134.60 to 141.23. That's that buy range that we like to buy things in. Our target based on an ABCD strategy is, this is the A to B point, this is the B to C, and the C to D projects up to 142.23. We have a stop price at just under this level here, which gives us a pretty good area. It's about 5 points down, and it's about 5 points up. Now, we'd like it to be a little bit more than that, but that's just on the first ABCD. The second analysis we're going to do is that we have a second target at 180. How do we come up with 180? Well, let's take a look at it. We have a Fibonacci area that goes from this Fibonacci range. This is the 100% move on the Fibonacci. Notice how it came back to exactly the 382 Fibonacci retracement area, which is a very healthy retracement area. A 618 is a little less healthy. It shows there's a lot more selling. So then right from that Fibonacci area right here, you saw it extend up, and it hit this breakout point and went above it. And now the second target that we have is about 180. That's that 1.618 Fibonacci extension level that we like to strive for. So our first target is 142. That's not very much higher than the stock is today, about 5 points. But we feel that with the downside, that's a pretty decent 1-to-1. If the market keeps going up, then we've got a pretty good position here. The second range is going to be 180, and that's a little bit more aggressive, but it's about 40 points higher than it is today. And of course, it's obviously a longer-term play on that. If we get a nice breakout and we get some decent volume, we're not having that great a volume, but if we get some volume behind this and the market continues upwards, then we like it. Today the market's just mixed, so it's a pretty good time to enter into a trade because volatility's down. So we looked at the options prices on it, and they're actually kind of expensive according to Black-Scholes. So what we did is we're looking at doing a spread. So let's bring in our spread searcher here, and we want to do a vertical spread on Ulta. And we just resize this window here for us, make sure you can see everything that we've got going on. All right, so we did a search on the Ulta. Right now it's trading at 137.51, and we said, okay, give us the spreads that are 2 spreads apart, and we want to go with a vertical spread. because we're bullish on the stock. We think it's going to go up. We think that's a pretty good position. It's going to go out about 92 days. Give us all the results of those spreads that go out 92 days. Then what we do is we sort by the reward risk ratio. We like to have a 5-to-1 reward to risk ratio. So we're going to just scroll down until we get around the 5s, and we're going to look for a call position. I'm a little more familiar and comfortable with call positions. It's a little easier for us to get our brains around it. And when you're looking at a long call vertical versus a long put vertical, there's not a lot of difference in the results, but we're going to kind of just pick this long call vertical here at 5.67. So we've got that 5.67, and we're going to say, okay, let's look at that. Our maximum reward is 850. Our maximum risk is 150. Well, I don't want to just invest $150 in this position. So let's go ahead and analyze it. We're going to bring it down here and see what the actual spread is. And when we look at it, we see it's one call, and we sell one call against it. Well, let's crank that up because we want to invest about $3,000. At least that's what we're going to analyze here. So we're going to say this is going to be about 30 calls to buy, and we're going to sell the 30 calls against it. So we're going to buy the 165s, and then we're going to sell the 175s. Now that's way out of the money. But we think that's, if it gets up this high, that's going to protect us. That's one way to do this, is look at this way out of the money call. So let's look at how we would trade this. We would trade it, take a look at what we've got invested. It's about our $3,000. Our estimate price for this spread is 1.08. Our maximum risk is the amount that we've invested in it. Of course, we can always scale out of the position if it moves against us. But this is going to be a couple of month position that we're going to be in. The expirations are in June, and we're going to be doing 30. So we're going to buy to open 30 Ulta calls, the 165, and we're going to sell against those calls, the 175s. The spread's going to cost us approximately, who knows, 108 to 155, somewhere in that range, natural or 1 point. That's the midpoint. We'll probably have to pay a little bit more than the midpoint. But now you can kind of see what happens if we do that option. Let's look at the 2D graph of that option before we pull the trigger here. So this is where the stock is today, about 137. And these two are the standard deviation levels, okay? So the first standard deviation, there's a pretty darn good chance that it's going to get to 155. It falls between these two standard deviation levels. Pretty good chance it's going to go to 120.79 also. But if we get the right volume in the right market, we think we're going to be skewed toward this area. If we happen to get luckier and we can get to the second standard deviation level, now remember we got a target at 180, but if we can get here to 163, which according to this skew is showing that it's going to get to 163, there's a 95% chance that it's going to happen within that area. Well, then we can see that if we go up here and we look at the P&L right on the top line, right over here. Let's look at that number as we go higher. So at the first standard deviation, we make $3,400 in profit on our position. In the second standard deviation, we make $7,700 in profit on the position. And if that stock gets to 180, let's take a look at what that number does. The 180 is right there. And that's a $16,000 profit. That's our 5-to-1 on our $3,200 invested. You can see those same numbers down here. So here are the theoretical P&Ls. We're risking $3,219 on the second standard deviation, but if it goes to the second standard deviation higher, we make almost $14,000 on that position. So that's how we look at it. Let's go ahead and pull the trigger on this position. We're going to go back here. We're going to trade, and we're going to say, okay, what's going to give us the best, most likely chance to get into that? The midpoint is 108, but they're not going to give us the midpoint. Let's just figure maybe we're going to have to pay 110 for that position. It's going to cost us a couple $100 more, but hopefully we'll get that position. Anyway, we'll take a look over time and see how we did. So we're risking $3,450. Our maximum reward, if this thing goes way, way, way high, is $26,000. I like that reward to risk ratio. And I'm willing to say that if it goes down by 25%, in other words, we end up, it end up moving against us by 25%, we're going to close that position out or roll it, or we'll do something to adjust it.